Hey everyone, PK here. I'm so grateful for you to be joining me again. I really appreciate you being part of this podcast community, where we're really trying to achieve financial happiness. Financial happiness doesn't equate to overall happiness necessarily, but it goes a long way. So thank you for being with me. I got so much great feedback on our last episode, a Q&A. So in this episode, we'll be doing the same. Okay, so we'll be going through two questions. The first question is, stocks versus property investing. What can property investors really learn from stock investors to beat other property investors? What is better, stock investing or property investing? And if we can achieve huge results in property by using stock investing principles and data, then what are those and how should we do that? Okay, really interesting question. And the second question in this episode will be the end-to-end process for buying an investment property DIY. Okay, so it's really confusing sometimes. You don't know what you don't know. You're scared of making mistakes. There's so much involved in buying a property, especially interstate, especially if you want to get a good result. You need a team of mortgage brokers, conveyancers, select suburbs. I'm going into the answer a little bit, but we'll be spending some time going through the 6 steps so you can really demystify it in your mind and, hopefully just take that next step. It's not about achieving, the $100,000 passive income goal right now. It's just about achieving the next step. Okay, taking the next step, because that's all that we can do. So hopefully this episode allows you to do just that. Thanks so much for listening, guys.
Do you want to achieve wealth and passive income through property investing? PK Gupta, host of Oz Property Investment Mastery, will help you achieve passive income by buying top 5% growth and positive cash flow property and building a portfolio using data without you wasting months of time doing research, spending weekends at inspections, or dropping $10,000 to $20,000 on buyer's agents each time. So if you are confused and overwhelmed by the amount of contradictory information available online and don't know where to start, then this show is for you.
So the first question is stocks versus property investing in Australia. Which should you prioritize? And what can we learn? What principles from stock investing can we apply in property investing to get an unfair advantage? So let's just think about how you make money in the stock market. And bear with me, this is going to be useful. You make money in the stock market in its simplest sense by buying low and selling high. Okay, you buy a stock really low, cheap, and you sell it in the future when it has risen. Now, the thing about the stock market is that everyone is trying to do that. Okay, no one is buying a share or no one is buying a stock because they have some warm, fuzzy feeling that they want to help a company or they want to use that stock as some sort of charitable or philanthropic venture. Okay, every single person who buys a stock, whether it's 1 or 1 million stocks in the share market, in the stock market, buys for the intent of making a profit. Okay, and I know I used to be an investment banker covering oil and gas stocks, Shell, Woodside, Origin, Rio Tinto, BHP, Oil Search, etc. That was what I used to be doing 90 hours a week. It was pretty tough. And I know how hard it is to make money in the stock market because everyone is trying to do that. Now, juxtapose or compare that to the property market. Is everyone trying to make money in the property market? You as a aspiring property investor or an experienced property investor, maybe you have a young family and you've already got a couple of properties under the belt or you're starting your property journey. You as a property investor want to make money in the property market, but 70 or let's say 60 to 70% of people aren't really too bothered, right? And the reason is that 60 to 70% of people in Australia who buy residential real estate buy it for the purpose of living in it. And yes, of course, no one's going to say no to capital growth. No one's going to say no to making money, but those people aren't buying and selling with the express intent, with the scientific intent to make money, right? They just want shelter. They just want somewhere to live in, an emotive draw to a particular suburb, to a particular property, to a particular town, because that's where they want to house their family, okay? And what that means is that gives us property investors, or future aspiring property investors, such an amazing head start in how to make money. Because in the stock market, you are competing against millions of cutthroat investors trying to beat you. Because the only way that you'll make money in the stock market is if you buy low and sell high. And that means that someone has to actually buy high, right? So someone thinks that that stock is going to go even higher, and you think it's going to come down, therefore you'll sell. So another sophisticated person is betting against you, right? It's sophistication versus sophistication. Whereas in the property market, the majority of people who buy and sell residential real estate are not sophisticated. They are not buying with the intent of making money. They are not selling with the intent of making huge cash. And that puts us in such a terrific position, right? Because if you can educate yourself, if you can know more than those 60 to 70% of people, then you are, miles ahead of them, and you can actually, take advantage, right? It's a bit like running a 100-meter sprint, but, 60 to 70% of your competitors are starting 10 meters or 20 meters behind you. That's going to give you such a head start. That's going to give you such an advantage, right? In the stock market, we make money through long-term trading and short-term trading. Long-term trading means looking at the discount cash flows of an organization, seeing how it will perform over the next 5, 10, 15 years, and discounting or bringing those future cash flows, stick with me here, into the present and saying, okay, if this is the value of the company and these are how many stocks or shares are for offer, well, this divided by this equals your value per stock. Okay, that's long-term trading. And short-term trading means looking at charts, looking at graphs, dozens and dozens of them, and really assessing whether this stock is going to bump up or whether it's going to collapse or whether it's going to be volatile and where we should buy and sell. Now, in property investing, it's really remarkable, and I'm sure you will resonate with this. It's really remarkable that not enough or nowhere near this level of sophistication is used by certainly those 60 to 70% of owner occupiers, but even the 30 to 40% of investors, right? Even the 30 to 40% of investors who are buying and selling property for the express purpose of making money, positive cash flow, and capital growth to develop a passive income for themselves and their families. Even of the 30 to 40% of investors, the vast majority, I'm going to say probably 90% plus, are not looking at the data. They are not looking at the trends. They are not looking at the graphs. They are not looking at the charts. They do not know, A, where to get the data, and even if someone, dumped it in front of them, how to interpret that data, how to interpret the different factors, what are their relative weightings, how do we know whether a factor is strong, weak, or indifferent? How do we interpret the trends? Just because a factor is strong right now, is it gaining or is it sloping? Is it declining? Right? So just like in the stock market, we analyze charts, and if you do a quick Google search, there's all these all this jargon for how you can read charts and how you can interpret it, and it's like a huge science. It's not perfect. No one's really cracked the code to say predictably we can make money every single day in the stock market, but there is a very, very, very close and precise and refined science to how to make money in the stock market using data, right? Factors, their relative trends, their relative weightings, how strong, weak, or indifferent they need to be, all together for us to say, yep, this stock is actually going to do well. Similar to that, now in 2020, we have ample data available to us in the property market. Go back 10 years, go back 15 years, you had to rely on population growth trends. You had to rely on proximity to parks, schools, shopping centers. You had to rely on proximity to CBD, which doesn't matter at all. I'll do a post on that soon. You had to rely on these sort of blunt instrument measures to say, all right, this suburb is probably going to do well over the super long term. In the short term, if it does well, that's a bonus. All right, but now fast forward 5, 10, 15 years, in 2020, in fact, for the last 5 years, we now have ample data. We now have enough information. We have enough charts, enough graphs, and I'm not just meaning yield and capital growth history and vacancy rates and things. I'm talking, and just to give a tip of the iceberg, days on market, developable land supply, stock on market, average vendor discounting, job advertisements, income increases, the type of professionals that are increasing in that particular area, etc., etc. We can digest this information and actually very, very, very scientifically assess whether this suburb is going to do well, whether this property is going to do well, whether it will give us positive cash flow now and in the future, but also, and in fact, somewhat more importantly, whether it will give us capital growth. We want that thing to go up and take equity in the first 2, 3, 4 years, right? So the main purpose of this is just to say there are not billions, probably tens of millions of people worldwide investing in the stock market using science, data, sophistication, algorithms. But almost no one is doing that, even amongst investors in Australia. So, if you do want to do that, then you put yourself so much in advantage compared to owner-occupiers, but even, in such a more superior position to the vast, vast, vast majority of investors. Because I tell you, even 90% of buyer's agents aren't looking at this data. They just have their own patch in which they know each house really well, but still it's just that patch. What if there's another patch, suburb, location, etc., that will do well, that will do better? Okay? So the key takeaway from this is that if you're not looking at sophisticated data, you are leaving money on the table. You are purposely saying, I don't really care about my property investing. You're treating it like a place to live. And that's really not how you should be going about it if you're a property investor. Okay, so if you already know how to do this, go ahead and do it, right? Make sure you do it. But if you don't know how to do this, then I'm happy to help you. I've formed a system that makes it very easy to understand. Oftentimes when people talk about data, including myself, a whole bunch of people become a little bit overwhelmed, their eyes glaze over, all data, maths, algebra, all this stuff. It's, you know what, like, even if I'm leaving $100,000 on the table, let it be on the table. I don't want to deal with it. But when that data, that system, that formula, those steps have become simplified so that the average person can understand it, then there's really no excuse for you to leave money on the table. Okay, you can buy high growth, high positive cash flow property predictably using data. And if you can do that yourself, then I encourage you, do it. But if you do want help, a predictable way to do this, then reach out. And the second question in this episode is, what is the end-to-end property investing process? Okay, what's involved? What do we need to do? Hopefully this helps. All right, so, you're in your late 20s or in your 30s or in your 40s. You have a wife or a husband, you're in a relationship, you might have a couple of kids. You're thinking out 10, 15, 20 years out to your retirement. You may already have an investment property or may have 0 investment properties, and you're really looking to take charge now and figure out how to get ahead, how to develop some sort of secondary passive income source through property investment, but you have no idea what you're doing. Okay, you're not alone. I speak to hundreds and hundreds of people every single month that are exactly like this. And the first thing that I think they default to doing, you might be defaulting into doing, is to say, look, it's just all too hard, it's confusing, it's overwhelming, I don't want to make a mistake. Let's just outsource it to the professionals, in quotation marks. However, those professionals, if they are actually quite good, they come with a hefty price tag. A good professional will come with a price tag of $10,000 to $15,000, and you don't really want to pay that. At least most people don't want to part with that. So I'm going to talk about today how you can actually cover off both the art and science of property investing yourself, why you don't need to spend all this money for a super expensive professional. Okay, of course, it does take a little bit of learning. It does take a little bit of time, maybe 2-3 hours a week for a month or two. But if you have that, then you really don't need to go to a professional or an advisor, agent, something like that. You can do this yourself. You truly can. And I have literally hundreds of case studies proving that you can. But let me just explain to you right now how you would do that. Okay, so to start property investing, you need to develop a strategy. Now, I've talked about this many times before in these videos, but an essential part of your strategy is borrowing capacity. So don't go to the bank directly, go to a mortgage broker. They're completely free, a good mortgage broker, and they will tell you they'll tell you what you can afford to buy, right? And so that's a key part of your strategy. And then you need to figure out what yield you want and things like that. And then it's all about, once you know what you can afford and what yield you want, then it's all about going into suburb selection. And suburb selection is all about data. There are some people that say that you must have lived in the suburb for a while to really understand it. There are some people who say that you need a really professional buyer's agent that knows the ins and outs, every crack on the footpath in a particular suburb, in order to really understand what to buy and things like that. But you really don't. All you need to know is the data, and I've harped on about this a lot, so I'm not going to talk about that too much. Suffice to say though, in about 3 to 5 hours worth of work, you can take the 15,000 suburbs across Australia, hone them down using data filtering, and come up with your best or 2 best suburbs that you should be buying in. Now, once you've selected the suburbs, then it's about where in that suburb should you be buying, which streets and which types of houses. And that is easily achieved through more data and through more qualitative data. So not just quantitative, but qualitative. So what I mean by qualitative is zoning. Where are the flood zones? Where are the bushfire zones? Where are the flight paths? Where are the main roads? All this sort of thing that you can actually find mostly on Google and also on local council websites. So you can hone into the various pockets of the suburb that are worthwhile buying in. Once again, never having traveled to the suburb itself and not having to outsource it to a professional. And then it's about finding the right types of properties. Now, there's a set criteria that you need to follow in terms of what type of criteria you should buy. For example, it should be north facing, should be away from power lines, shouldn't be on a main road, it should have the typical bedroom configuration that the typical type of demographic has or wants in that area. And all these sorts of things can be helped or can be aided by a property manager in the area, right? A property manager in the area, for those of you who don't know, is not a real estate agent, right? There's someone who will manage your property once you have actually bought it, collecting rent, managing maintenance, all that sort of thing. But here's the thing that most people don't know. You can actually get your property manager, let's say I'm in Brisbane, I want to buy in Sydney, I can get a local property manager free of cost to do my inspections for me. So that part of the process is taken care of you, and then it's about negotiating. Now, negotiating can be learned, right? Like I said at the start, if you have 2 or 3 hours spare in the week for about a month or 2, you can learn all this negotiation. You don't need to do it face to face or over the phone call. You can do it over email on the contract itself. It's pretty straightforward. It's not rocket science. There are tips and tips and techniques that you should understand, but all very easily understandable and learned. And that way you can do it yourself, right? And so you negotiate with the agent, and then your conveyancer will hold your hand through the rest of that contract process. So you don't have to worry about things. Your property manager in the meantime is, once the house is unconditional, the property manager is finding a tenant, right? And once you've settled, which your property manager also will handle for you, the exchange of keys, the pre-settlement inspection, then it's about getting a depreciation schedule, which Once again, if you don't have a quantity surveyor, let me know. I'll give you mine free of cost. Quantity surveyor does a depreciation schedule which helps you get your tax deductions right up, right? You want to save on tax. What else is left? And then at the end of the year, to actually claim deductions and claim everything, you need your accountant. So once again, if you don't have an accountant, let me know. I'll share mine with you free of cost. And so really what I'm trying to articulate is people get stuck in property investing of how to start, where to buy, what to buy. How to start can be helped and can be understood just through some coaching, some mentoring. You don't need to spend $10,000 or $15,000 on that, okay? Effectively, how to start means what price point, which is answered by the broker, what yield, which is helped by some strategy, not $10,000 worth of strategy, but a bit of strategy guidance, whether I should be active or passive, right? Should I do developments and things like that, or should I just buy a set and forget? And the fourth question, and how do I start, is am I open to regional centers or capital cities only, right? What's my risk appetite? Am I open to buying in non-capital cities or not? And once again, you can decide that for yourself looking at data. Regional doesn't underperform capital cities, but it can be a bit more volatile. So once you've answered those four questions, what people get stuck at is, well, where should I buy? And I'm telling you over and over again that there's a number of factors you need to consider. All of this can be done in front of your computer, in front of your laptop, at home. I have literally hundreds of case studies of clients that have made huge positive cash flow, huge capital growth, that did it in front of their screen at home, picked and selected the suburb at home. And then what people, encounter, the hurdle that they need to cross as well within that suburb, where should I buy? Like I said, that can be overcome using council websites and also some on-the-ground knowledge that a property manager can help you with. They know the qualitative lay of the land. They're actually there, and you don't need to see them in person. Everything can be done over the phone call, and they're free of cost, which is amazing, right, for this sort of knowledge. And then it's about buying, which a conveyancer helps with, and the property manager holds your hand through the process of finding and keeping a tenant. And it's all doable very easily by yourself. It seems very overwhelming. Where should I buy? What should I buy? Am I making a mistake? Is this going to be a dud property? Is this the worst decision of my life? Should I even do this in the first place? You do need some help to understand the process, right? So most people in my experience, whether they're already property investors or they're brand new, they need some help to understand everything a little bit more detailed. But what you don't need is $15,000 or $10,000 worth of help, okay? And if you understand how to do it once, then you can just repeat it with the same team of broker, conveyancer, property manager, an accountant. You can just rinse and repeat this process and accumulate properties over the course of time yourself. You don't need to pay $10,000, $20,000 every single property. In fact, it's quite interesting. Most of my clients, if I'm being honest, they already have one or two properties, and then they've gone to a buyer's agent or an advocate or a property marketeer or something like that, and then they come to me after they already have one or two properties saying, look, now PK, I want to learn it. And I just ask, well, why didn't you want to learn it yourself at the start? Save that money and get better results and become self-sustaining. And they said, look, I thought it was too much. I just thought I couldn't handle it. I thought I wouldn't know what to do, and therefore I just wanted to outsource it. But now I realize that, yes, it's not a walk in the park, but it's not rocket science either. And I would have rather, having done this journey again, I would have rather done education at the start. I would rather have someone hold my hand through the start, through learning, through education, and then I could have been self-sufficient, right? So if you don't have any properties yet and are finding all of this really overwhelming, I just want to tell you that, yes, there's options to spend $10,000 or $15,000 on agents, and look, all credit to them. But most property investors, unless you're a busy CEO, have zero time or zero passion about property. Most people, 90+% people, can do it themselves with a bit of hand holding. And there are hundreds of people, there are thousands of investors that have done it this way. So don't be overwhelmed. You can learn this. It's not hard. You know, a data scientist can do it, a surgeon can do it, an electrician can do it, a teacher can do it, a nurse can do it, a housewife can do it, a house husband can do it. Everyone can do it themselves. It just requires a bit of learning, like anything. Thank you so much for listening, guys. This is just raw. It's just straight from, I want to say straight from my heart, but it's obviously from the mind. But you know what I mean. This is not script, as you can see. The audio quality is not fantastic sometimes. Thank you for tolerating that. I'm just trying to, give you as much value, because it's the content that's more important than the production quality, but we'll get there as well. Thank you for bearing with me. I really do want you to get ahead in your property investing. If this, makes a difference to you, I would love for you to leave me a review on Spotify, iTunes. But even if you don't, I just want to say thank you for listening and take that next step. Catch you later, guys. Bye.